9/22, 2013, the S&P 500 made another 52-week high last week on the FOMC announcement. The high was 1729. The thing about the FOMC is that they didn't taper, so we got this big up move. We are at this point in time extremely overbought on the, well, we're not overbought as we were, but the monthly is what we're going to take a look at. Here's the monthly bar for the month of September, which is usually not a very good month for markets. However, the bull mentality and the Fed not tapering has gone to extreme levels of about 93%, 0.99 on the percent K. The momentum indicator has peaked up here at 18.6, and we are ripe for a pullback. On the monthly, as far as the 10-month moving average goes, as where the latter part of September can get very ugly, meaning that they bucked the trend for the first 3 calendar weeks with the S&P, is that what we're saying is that the 10-month moving average is down here at 1590 on the S&P. The weekly 1680 is the first support level. When we had that August correction, of course, we came right back up in 3 calendar weeks, got above the 10-week moving average. That will be the near-term support level of 1680, and respectively the 20-week moving average, which is going to be right around 1657.63 as of the reading of this tape on 9/22 of 2013. The markets had a huge sell down on Friday with a quadruple witch, meaning that every time that we get up here, there's a lot of problems that lay ahead. One is the most significant one, starting right around October 8th, is that we're going to have the earnings season for Q3. It's going to be a very soft earnings reporting session. A lot of stocks are extremely overbought in the cycle. Bulls better be aware. Once again, bulls better be aware, because there is a significant pullback that will happen. I know that we did say in September it was a very unusual month. High frequency, bidding the stocks up electronically have gotten them up to these levels. So as we move forward with the debt ceiling, the government shutdown and various other things can cause a lot of extreme volatility. The bull run's been extremely well with pullbacks. We had one, we had two, and now we're going to work on the third pullback going into the ending part of September. And when we get into the October earnings season and the volatility that the government is going to play about the health care and the Obamacare, the government shutdown, we had something like that happened back for the older crowd of people. If you remember back in 1995, it hurts a lot of things when there's a government shutdown. One of the things that hurts is terrorism. And the earnings calendar in the retail part of the sector, we're going into the fall trade as of today, 9/22, 2013. Fall and seasonality has come upon us, and that now with the seasonality, there's going to be a lot of changes. One of the things that we've been trading here, just so people know, is that the put options that were traded, we had bought some of the 1725s put options for calendar monthly expiration for calendar monthly October. One of the things that we can say is that the 1725 put, which I'm going to show here on the S&P on a daily chart, is that we got down here to where it was very, very, very oversold. This is a 1725 put right here on the S&P that a lot of people were buying. I'm going to also show what the 1720 put looks like Here's the 1725. We had a November and an October. So the last one was in November, and we're going to show exactly where the 1720 put would come into play in the cycle. Once the S&P does break, this is November 1725. It got very oversold down there at $33, and it's popped back up to 42.50. Naturally, before all of this happened, they were up here right around $100 a contract. So when we take a look at the 1725s, which is behind here, this is the 1725 October one. So basically we hit 2150. Our entry was 2150, but due to the high volatility, you can see here on a weekly level here, I'll put this on a daily level so you can see how they were marked down. So we popped off of that 2150. They have a ways to go up to $50 a contract. Let's take a look at the 1720 put for October. The 1720 put, which the S&P 500 closed at 1709 because we had that triple witch. Now this 1720 got down here. It was very cheap, $19.50. We're now at $28 on the high here. So any gap up in the S&P 500, we will look at engaging another entry here using this particular put right here. The 1690s, which is below the marketplace, we would be looking at this particular one here, got down as low as $10. There was a $5 pop here. They have a lot of room to go back up to. So post the FOMC announcement about not tapering, this is where they got very extremely deflated. They're when you look at the call and put ratio, meaning that your put side of the market is totally deflated and your call side of the market is totally super inflated. So there's a lot of room for this particular contract to go higher. It would be how you get the entry on it. So the S&P, the SPX, .x right here. This is the daily chart. That's Friday's distribution. You can clearly see that the 10-day simple moving average on a daily is 1700. 1680, where it will test, will be that 50-day at 1678 on a daily simple moving average. And of course, the 20 is 1671 down here. So when we take a look at where we're at, we were 100% overbought on Friday when we hit those highs up there on the percent K, and we're coming down. So we have a 1720, we have a $1,700 put that we will show as far as what that one looks like. The 1700, which got totally deflated down here at $13, it once again has popped up. So as we trade from 1709 down to the strike price of 1700, these have a lot of room to go higher going into the calendar October period, monthly expiration, and the next couple of weeks it's going to be a rocky road for the S&P 500.